All right, everyone, let's dive into the world of corporate finance, because today we're going to unravel a really fascinating process: consolidation accounting.
You know those huge companies, right? The ones that seem to own everything from your favorite soda to the latest tech gadget. Have you ever wondered how they tell the world, investors, regulators, people like us, what they're actually worth as a single giant empire? How do they possibly combine all those separate businesses into one coherent story? Well, that's exactly the puzzle we're going to solve today. The answer, my friends, is something called consolidated financial statements. Now, the best way to think about this is like the ultimate corporate family portrait. Instead of seeing a bunch of individual photos of the parent company and all its kids, the subsidiaries, you get one big, beautiful picture showing them all together, as if they were a single economic unit. It's all about showing the real substance of their relationship, not just their separate legal paperwork.
So how do you decide who actually gets to be in this big family portrait? Well, it all boils down to one absolutely critical concept. The magic word is control. This is the trigger for everything in consolidation. When one company, which we call the parent, has a controlling financial interest in another company, the subsidiary, that's it. That's the moment the accounting rules step in and say, okay, you two have to file your report card together from now on.
Now, defining control isn't always as simple as it sounds. On one hand, you've got the classic approach, the voting interest entity model. This is super straightforward. If you own more than 50% of the voting stock, you're in control. End of story. But then you've got this more, let's say, sophisticated model, the variable interest entity. With this one, you might not even own 50%, but if you have the power to direct all the important activities and you're the one who gets the profits or takes the losses, well, you're still in control. It's really a shift from focusing just on ownership to focusing on who's actually calling the shots.
So once control is established, usually because one company buys another, the accountants don't just start winging it. Oh no, they have to follow a very specific rulebook. So let's look at the official method for bringing these companies together on paper.
It's called the acquisition method, and it's got 4 key steps. First up, you got to identify who the buyer is and the exact date it all went down. Second, and this is a big one, you have to measure everything at its current fair value. So the real market price of all the assets and debts you're taking on. Third, you have to account for any non-controlling interest, which is just a fancy way of saying the piece of the subsidiary you didn't buy. And finally, you do the math, which leads you to one of 2 outcomes, something called goodwill or a gain.
And that last step brings us to one of the most interesting and honestly most misunderstood ideas in all of accounting: goodwill.
So what on earth is goodwill? Well, it's considered an intangible asset. It's basically the premium that a buyer pays over the fair value of all the stuff they just bought. So why would anyone pay extra? Well, it's because they're buying things you can't really put a price tag on, like a stellar brand reputation, a super loyal customer base, or a team of brilliant employees. It is literally the price you pay for potential. Okay, let's walk through the math here. Entity C paid $192,000 for its chunk of the company. Now, the subsidiary's net assets, that's just assets minus liabilities, are worth $210,000. We also have to account for the 20% that Entity C doesn't own, the non-controlling interest, which is valued at $48,000. So the formula is the price you paid plus the non-controlling interest minus the net assets. That leaves us with a difference of $30,000, and that difference, my friends, is goodwill.
Paying a premium is pretty common. But what if you're a really savvy negotiator? What happens when you get a really, really good deal?
Well, in that pretty rare case, you get the exact opposite of goodwill. So in this example, the subsidiary's net assets are worth $260,000, but the total price paid plus the non-controlling interest is only $240,000. You actually paid less than the stuff was worth. That $20,000 difference gets recorded as an immediate gain from a bargain purchase, and it goes straight to your income statement. Not a bad day at the office.
Okay, so the deal is done, goodwill is on the books. Now what? Well, the real work of consolidation is just beginning. It's something that happens year after year. Let's take a look at how they actually create that single story.
So the process is kind of like weaving 2 financial tapestries together. First, accountants just add everything up, line by line. Assets, liabilities, revenues, you name it. Then they make some really important adjustments. For example, the parent company's original investment account, that gets removed because it's being replaced by the subsidiary's actual assets and liabilities. Then goodwill and the non-controlling interest get reported as their own separate items, creating one seamless financial report. Let's see this in action with a parent company, Platonic, and their subsidiary, Socratic. Look at the consolidated statement. You can see their individual numbers are just added together. Sales of $250K and $120K become $370K. Simple enough. But here's the most important part. Look down at the bottom lines. The total combined net income is $65,000. Now, since Platonic only owns 80% of Socratic, the report has to show the portion it doesn't own. So you can see right there, it shows that $5,200 of the profit actually belongs to the non-controlling interest. This gives investors a true picture of who really earned what.
All right, let's get to the final and maybe the most important step in making sure this whole consolidated story is actually a truthful one. This is all about avoiding financial illusions.
The logic here is actually super simple. If you're treating the parent and its subsidiary as one single company, then any business they do with each other has to be erased. It has to be eliminated. Otherwise, a company could just sell things back and forth to itself to make its revenues look bigger. Think of it like taking money from your right pocket and putting it in your left. Are you any richer? Of course not. The exact same principle applies here.
Here's a perfect example. Platonic's books say Socratic owes them $12,600. Socratic's books say they're owed $8,500 from Platonic. On their separate books, those are real numbers. But on the consolidated family balance sheet, poof, they vanish completely. Because from the perspective of a single entity, the company just owes money to itself, which is totally meaningless. So these balances are completely eliminated.
And this elimination rule applies to all kinds of internal transactions. Any profits on inventory they sold to each other, gains on assets they moved between each other, interest on loans between them, even dividends the subsidiary pays up to the parent, all of it has to be wiped clean from the final consolidated report to show a true picture to the outside world.
Okay, that was a lot, I know. We've covered the whole process, from control all the way down to eliminations. So, you ready to apply what we've learned? Let's do a quick problem.
Okay, take a look. King owns Simon. We've got their individual liabilities, and here's the key, there's a $100,000 loan between them. Simon owes King. So based on everything we just talked about, what is the correct total liability for the consolidated balance sheet? I'll give you a second to think about it.
If you said B, $550,000, you absolutely nailed it. It's a simple two-step process. First, you just add the two liabilities together. $450,000 plus $200,000 gets you to $650,000. But then, and here's the key, you apply that crucial final rule, and you eliminate the transaction between them. That $100,000 loan is internal to the family, so it's got to go. $650,000 minus $100,000 gives you the true consolidated liability of $550,000. So the next time you look at a corporate giant's financial report, you'll know the incredible amount of work that goes into telling that single unified story. But it does leave you with a question, doesn't it? In a world of incredibly complex corporate structures, does this one perfect picture truly show you everything you need to see?